On this episode of the Trade Busters podcast, we're going to be talking about the Trinity trading system and the first part, which I'm calling the Theta Engine. As always, just a quick disclaimer, I'm not a financial advisor, so everything on this podcast is for informational purposes only and not to be construed as investment advice. Now, what is the Trinity system? This is something big that honestly, not necessarily something I've been working on recently, but really this is the culmination of everything that I've been working on the last, half a year, few months, and it really represents a fundamental shift in the way I approach trading and investment. So, as some of you may have known, the reason I haven't done an episode in a little while is because I've been working on a hedging strategy to sort of supplement what I've been doing with the 45 plus and the bomb shelter, doing a lot of testing, basically working around the clock. And I think I've almost got something. Well, I finalized it, but I need to kind of get the information tidy and put together so I can do an episode on that. But essentially, the Trinity system is meant to be an all-inclusive system that provides an income strategy, sort of the base, profit generator. It has the bomb shelter hedge, which you guys are familiar with, and then the third piece, which is the yet to be named kind of supplemental hedge that I've been working on. And what is the Theta Engine? The Theta Engine actually is in fact what I am now calling the 45 DTE or the 45 plus DTE strategy. And why the name change? This is really, again, a sort of a rebranding and again, just a fundamental shift in the mindset of how I view this entire strategy. And I'll get to that in a second. And I mentioned the bomb shelter is part 2, and then the yet to be named hedging system is going to be part 3. And these are meant to be 3 pieces that go together to form a full comprehensive trading system, yet at the same time, the bomb shelter and the hedging system that I'm going to introduce in a later episode, those are optional. They're meant to be complementary and used together, but again, they're optional. And the core kind of driver of profits is meant to be the Theta Engine, right? And if you think about it, I've taken you guys through the last few months, starting with the 45 DTE to 60 to 90 to 120. I've done various profit targets. I've done a cap on the days in trade, then there was a no cap. And what I realized is all of these little parameters, they're just sort of adjusting the quality and behavior of and sort of the equity path of the strategy. But at the end of the day, what is the goal of all this, right? It's just to make money. It's to make profits, And so right now, just for your information, I'm currently running the base Theta Engine at the 90 DTE 60% max profit configuration with no maximum cap on the position, the book size, so to speak, right? No DIT hard cutoff. And why is that? Because, for one, we did a lot of back testing, and having no cap means you're not cutting off trades early, which actually maximizes the premium capture rate. And you'll see on the 45 DTE page, which I'll probably rename soon, but the capital efficiency study shows that you get a pretty high PCR. I think it was like the 27-28%. And something I've noticed when I'm trading this, things people talk about, managing the book size. And yes, it's true. If you have a higher book size, you have more value at risk. You're going to have, a bigger potential loss if you get the so-called book wipe or nuke risk. But something to think about is that, if you have a lot of positions on, they're going to be at different maturities, right? So you start at 90 DTE, and let's just say you carry a position 30 days. 30 days, remember, you can only put on a position once every, 5 days a week. So 30 days, you're going to be basically having, 21 positions. So they're not all going to be at the same maturity. There's going to be one at 90 DTE. The original one's now be at 60 because it's 30 days later. You're putting on a fresh position. And so they're all going to behave slightly differently. Obviously, they're correlated, but the Greeks, the amount of decay, the theta, the delta, the gamma, they're all going to be behaving slightly differently. And really what you have is just a suite or a book that's generating theta, right? And the idea is when we hit a stop, it cuts off a position. Yes, you take a loss, but really what you're doing is you're just adjusting the delta, right? Because the delta probably grew too high on that position and got stopped. And so you're just cutting the exposure, right? So the whole point with using the stops and the profit take, these are just little tweaks that automatically sort of maintain your overall position exposure and risk, right? Because people talk about, and myself too, originally I like the shorter DTE because you can hit, and with the 50% max profit, you can turn things around in 10 days or less, right? And then we pushed this to 60% max profit because I realized you get a little bit more juice. The risk reward ratio is a little bit better, although you extend the time and trade a little bit. But there was this sort of obsession with keeping the book size small and having less positions or taking winners, right? But what I realized is this is a long-term, campaign style trade, right? The point is to put on a trade every single day or every couple days or every week or whatever frequency you've determined using the risk calculator, depending on, the credit targets and everything. But, what I realized is I don't really even look at this as trading anymore, right? We're not like looking for opportunities and trying to find different strategies or different trades and taking a profit and trying to recycle the capital. I mean, we are trying to recycle the capital, but the whole idea of even taking a profit, right, closing a trade and being able to put a winner on the trade log, that really, if you think about it, it's just mental accounting, right? Because we're going to put on another trade, right? Think about it. If you have no positions, you have no theta. No theta is no money, no profits, right? We are in fact building a theta engine, right? So the different DTEs you pick, right, that is going to impact the gamma of the positions. So if you use higher DTE with the same number of positions, it's going to move a little slower for and against you, right? And the theta, of course, is going to behave a little differently. You obviously get higher theta at lower DTE, but higher gamma. We all know that trade-off. That's the thing that Tasty Trade teaches us right from the beginning, right? And with the different profit targets, that's going to affect your time and trade slightly, which is true, which means bigger book size. But there's one thing that, if you guys have been following me, this is sort of the key piece that you need to keep in mind, and why I move it to a higher delta, for example. With the higher delta, right, and the higher profit target, and even the 90 DTE, when you capture more premium, right, because our entire credit target, this entire idea of using your target return to back out to the premium capture rate to figure out your credit target, that is anchored to a single point, which is your return target, which flows all back to the credit target. So for the same credit target, right, if your PCR is higher, you're going to be able to sell less premium because you're capturing more of it to hit your same return target, right? So if you do something to lower the PCR, even if it means you have a smaller book size or less time in trade, lower PCR means for the same credit target, for the same return target, you have to sell more premium because your PCR is lower. So that's kind of one wrinkle that you really have to be aware of. And I'm not saying higher PCR is always the best, but there's just a lot of things to balance, right? The PCR affects the book size, affects how much premium you have to sell. The DIT affects the maximum and the average book size. And even the idea of having the book size, right? Letting it grow. So you guys know that I put out the episodes that say, the risk is determined for these purposes by credit. Credit is a proxy for risk. And so I've did the risk calculator. I say, depending on the average book size, you have a certain credit target. It's going to translate to a value at risk on average. And I put some arbitrary book sizes so you can keep tabs on it. And the value at risk translate to, in the worst case, a level 1 book wipe. What does that mean in terms of loss? And so what I really encourage you to do, right, is obviously you should keep a trade log. But for example, on my spreadsheet, I have something where I just add up all the credits for my positions that I have live, and this spits out, this is my value at risk. And I have a thing that says, this is my book wipe risk, right? It's just value at risk times 2. So you can set it up in Excel in such a way as your position in your book size grows, you can monitor your value at risk. You can monitor your risk, right? And you can determine. Now, if you absolutely have to, and you're looking at that level 1 risk, and it's too high and it's unacceptable, then yes, prune the book, right? If you must. Okay, at the end of the day, managing risk is important, but you have to basically recognize that this is sort of a fluid situation, right? So I don't have that arbitrary DIT cap anymore because I do want to extract that maximum premium, right? The higher PCR, right? So this whole idea that, when I realized this, I don't even care about closing trades anymore, because if you close one, you're going to open another. Like and give you an example, like let's say mid-September, or, so today is October 19, 2021, but in the mid-September, we had sort of this market grind down situation where we had a lot of positions where you put on, they're kind of going underwater. It took a long time, and you weren't hitting the profit targets on time. And then, so as my position grew, IV was really high. So theta was high. Of course, our negative vega was high too, which is, risk, right? And we had more delta. And then all of a sudden we had this huge run up the last week, and I hit a bunch of profit targets, right? And in fact, I took a bunch of positions off, and now all of my remaining positions are close to their 50%, 60% profit target. And I noticed the theta is so low because we basically had, it just coincident that move up sucked all the premium out of them, right? So now the theta is low, and which is fine. I'm not going to do anything different, but you just have to recognize that this is a living, breathing thing. The Theta Engine, that's the core of your profit generator, right? And in the following episodes, I'm talking about sort of of course, you guys know the bomb shelter is sort of the tail risk hedge if you believe there's that nuke risk, but that's an optional add-on, right? And there's a certain drag associated with that. And I'll do an updated episode on that. And then, of course, the hedge that I've been working on, that's another supplemental piece. But this is your engine, the Theta Engine. And so what the mindset shift fundamentally is, you are just adjusting, right? And I've tried to make it so the mechanics, right, which isn't really that much to it. It's, the bracket order, the 2x stop loss or the 60% profit target, they just are little automatic adjustments. You're in fact adjusting your exposure. So on the one hand, don't be so obsessed with hitting a profit target. I know some people say, and I get it. If you're new to this, you're uncomfortable, you want to see some winners just to get comfortable. And I've seen people think, I took a 40% profit because I just want to get something on board. That's fine, but just know that in the long run, you want to let the numbers play out and let everything fall as they should, right? The only time I might close early is if it's the end of the day and I'm at like 59%, it's like 10 cents away. And I just don't want to, why hold the gappers for that last person? That's okay. Even then, I sometimes don't even bother because, again, I recognize that no position, no theta, no theta, no profits, right? This is just a long-term book that you're maintaining. And again, when you hit a profit target, it's basically because that position had enough premium come out that there's no longer much delta or theta. It's not worth the capital holding it, right? And you're going to add a fresh position. And when you hit a stop loss, it's basically the book telling you that the delta or the exposure was too much. Obviously, it comes back to controlling volatility. You don't want to take bigger losses as well. But that's just, it's all comes back to just kind of this self-regulating, thing that you're building, and you're just keeping it running, right? So, and on the flip side, on the stop loss, don't think of it as losing, right? Obviously you have a drawdown and you're going down in your P&L for that day or whatever period that is, but time is on your side, right? As long as you maintain, you're going to add positions, you have theta. Time is on your side. So, don't get too caught up in the idea of the win rate or how many things that can book. Because if you think about it, right, booking the profit, moving a position from my open position log to my closed trade log, what is that doing really in the moment? Nothing, right? Because as long as you have things running, you're getting profits every single day. It's not like all of a sudden let's say you booked a profit and it's like a $500 or $1,000 win or whatever it is. You didn't instantly get that $1,000 of profit. You were gaining that profit over the last 20, 30 days or whatever it took for you to gain that, right? You had an unrealized profit, but it was a profit, right? So if you have, this 20 position book and you're not closing anything, well, your P&L is still moving. You're going to see that time decay, right? So again, that is why I'm basically now calling this core income strategy the Theta Engine. And that covers all of everything we've gone through before, the 45, 60, 90 DT, 50% profit, 60% profit. And I'll talk about the delta in a second. But that's it. And the configuration you're going to choose specifically depends on what you're trying to get out of it exactly and your comfort level and the risk. And I'll make a note on the delta, why we moved to the higher one. And I mentioned it in, of course, the bomb shelter episode, which the higher delta gives you more premium per contract, so you can spend 10% on the hedge and have less drag. But what I found out is, and this may be partially because on the higher DTE, the gamma is lower and everything, but the win rate really isn't affected that much more at the higher delta, right? You're still seeing like a 85, 90% win rate, even at 15 delta. But at the higher delta, you are getting a lot more premium for each contract, which means what, right? At a fixed credit target, you can do less contracts to get the same credit, less unit risk, less leverage for the same profit. So again, don't get so obsessed. Number one, if you think low delta is higher win rate, that, seems like it's not true anymore based on my research, right? And if you think it's faster or 5 delta is going to get you out of, hit a profit target earlier, well, maybe, but again, that's sort of misguided because you don't really care about, turning the trades over. You just want to have quality positions that are manageable on risk, right? So the higher delta means less contracts. And at the 90 DTE, the gamma is very low, right? So rather than 3 contracts at 5 delta, I can do 1 contract at 15 delta and get that same gamma exposure, same delta exposure, right? And the gamma is going to be low anyways. So there's a lot of benefits to that. So you are in fact getting more bang for your buck, more capital efficiency. So that's what I'll say about the delta. And so again, focus on the long term. This is an income campaign, meaning it's a regular, mechanical, kind of persistent, ever-going kind of thing that you're just going to go day in and day out, right? This is not your usual trading and trying to kind of hunt for opportunities and looking for something interesting to trade and put it on just because it's high IV or whatever. And one thing